Professor Zach, and I'm here today to explain how to calculate your savings rate. Have you ever wondered if you are putting away enough money for a rainy day or your future retirement? Well, calculating your savings rate serves as a key component in answering this question. It tells you how much you saved, and also how much you saved relative to your financial situation. Let's look at Zoe at 2 different years of her life. She saved $10,000 in each year, but at 25, she earned $40,000. And at age 35, she made $200,000. While she saved the same amount, her savings rate will tell her that she is not saving enough in relation to her income and financial situation. Your savings rate is calculated by dividing your savings by your income over the same period of time. Does this sound easy? Well, there are many nuances to this calculation. Let's start with income, which can be from your job with an employer, your own business, or through investments. However, we will not be taking your gross income. We use net income after federal and state income tax. Social Security, Medicare, and unemployment tax are also removed. We use this method for 2 reasons. First, we want your savings rate to be an apples-to-apples comparison to the official average savings rates, published by the Bureau of Economic Analysis. Their method uses income net of taxes. The second reason we use net income is because the payment of a tax is largely outside of your control. Thus, a tax is categorized as a non-controllable expense. For your savings rate, we want to focus on spending that is based on your decisions, which is called controllable expenses. For instance, you can choose to go on a grand, expensive vacation, a small, modestly priced vacation, or stay local for minimum cost. Another example of a controllable expense is your car. You can choose to lease an expensive car, buy a new, but modestly priced, mid-class car, or buy a used, but older, economy-class car. All these decisions for controllable expenses will add or subtract to your savings rate. We define savings as what is left over after your spending. Savings is inclusive of loose cash in your wallet, the portion of your earnings left in your savings and checking accounts, and the earnings you have invested. If any of these funds are for future, near-term consumption, then you may elect to exclude them from the total. There is an alternative method to calculate your savings. You can search for and add up all your expenses. Then take your net income and subtract your expenses. Tracking expenses can be done by searching for transactions through your bank's website and statements. If you have multiple accounts, financial aggregator applications like Mint and Personal Capital automate the tracking of your expenses. These equations complete our lesson of the day. Please tune into other episodes which will explore how to set your savings rate, as well as strategies to increase your savings. Until then, have a great day. Thank you for watching this episode of Professor Zach Explains. Please click the subscribe button and check out my other videos. Your support is greatly appreciated. See you soon.